The one thing was that we had, even before this came out, was a stock market that had rallied 25% in just 4 months. So on a technical basis, it was becoming quite overbought. And then, of course, that meant its valuations got a little bit stretched. So I was already expecting for a pullback of anywhere from 3 to 5%, which is very normal, very healthy. But we had a market that was kind of priced for perfection. So that now that we have introduced some new news that is on the negative side, it could become to something more, 5 to 7%, and we may even overshoot down to down 10%. But those are normal activities we see in any market, and I just think that there was people are making a little bit too much that suddenly this is going to become a repeat of what we saw in the fourth quarter.
What happens if we either hear that it's going to be months until there's a deal, or what happens if they come out somehow tomorrow and say, we got a deal? Does the market tank? Does the market rally?
Well, the market will tank if it's going to take a while, and it will rally if they have a deal. The thing is, I think the chances of them having a deal anytime soon is very low. I mean, one of the things that you listen to some of these people, they keep saying, oh, geez, it's really in their best, both of our best interests to get a deal done. That's fine. But in the real world, I mean, if you listen to the people, the experts, the leaders who've actually spent a lot of time in China, who've done a lot of business in China, they've said all along that China was never going to agree to the way the administration wants them to intellectual property, and especially on the side of compliance. So this is going to drag out for a while. China, what they really want to do, they want to drag this out so it moves into the 2020 election season, and it kind of forces Trump to do something. I think eventually what they're hoping is that Trump will ask for something small, like he got in NAFTA, and then declare victory.
I don't want to minimize what happened Monday. I mean, it was like 9 out of every 10 stocks was down. It was pretty much a broad-based sell-off. However, if that's the worst the market can do on, albeit negative headlines on that trade fight, should we find any solace in that?
Well, it just goes back to what I was saying, is that it's a normal action in the marketplace. 600 or 700 point move, it looks bad and sounds bad, but on a percentage basis, at the worst case level, at least on a closing basis, we're only down 4.5%. Of course, we've bounced back another percent since then. So, yes, you can take solace to a certain degree, but I do think the market could reach some I think the market will rally a little bit more here this week, but I think you roll back over and probably make new lows for this move. But again, it's normal activity. People get caught up a little bit too much in the 1 or 2 day moves and then try to extrapolate it out way too far based on some fundamental issues. Markets sometimes move in very strange ways over the short term.
Do you think the market is still too complacent?
To a degree. I mean, one of the things we have to look at is two things. Number one, you look at the reaction of the bond market. Yields have moved back down. They didn't bounce back much yesterday, so they still believe there's some problems. And number two, my concern is on earnings. Earnings season was great. We beat expectations for the first quarter, but that happens every quarter. The thing is, earnings guidance actually came down a little bit. And with this issue on the trade side, I don't think we're going to get the bounce back in earnings in the second half that people are looking for. So I think the market's still a little complacent, but again, after a 25% rally over just 4 months, that's not the worst thing in the world.
Okay, lastly, there's this. I mean, trade is everything, I guess, right now. Brexit used to be everything. Now it's the trade fight. But there's something else that's big out there that a lot of people quietly are talking about, and that is the very high levels of corporate debt outstanding. Do we need to watch the HYG, the high-yield ETF, for any clues? Is that kind of the cousin around the corner that nobody's talking about, but he may be about ready to steal the scene?
It very definitely could be the issue. I mean, if things turn down. I mean, you have some of the, Jeff Gundlach's talked a lot about that recently, and we have so much debt that is right on the edge of being downgraded to junk. So we have this HYG, the high yield ETF. We have a lot more corporate debt that is right now investment grade that could easily move back down. That raises costs for all these companies and will hurt their earnings as well. So I think that's a big deal. The one thing that concerns me, though, is that the HYG isn't the leading indicator it used to be. It's, the last 2 times the market corrected in 2018, it went down at the same time that the stock market went down. So we got to keep an eye on it, but it won't necessarily give us the good lead that it has in the past.